Good day, fellow investors, and especially engineers. As I have many clients that are engineers, I often get very specific questions about certain investments, about certain financial movements, and consequently, I wanted to really explain something here that I hope will also be funny. If we go to key psychological traits of engineers, analytical thinking and detailed oriented. If you ask an engineer how much is 2 plus 2, well, it should equal 4. Perhaps if the engineer has a sense of humor, it depends on the tolerances, plus minus 1%. When it comes to investing, 2 plus 2 is rarely ever 4. 2 plus 2 can be 2 for 5 years, then it can go to 8. 2 plus 2 can be 1, never go to 8. So those are the difficulties I see, and I get a lot of questions. Great questions, keep sending them, but just wanted to make this a funny video for engineers based on the vagueness in investing, but also going through all the details, eliminating the unimportant to really stick what you can measure, because that is what counts. If we look at the S&P 500 over the last years, it is almost a 3x, but if we look from an engineering perspective, in 2018 the earnings yield was 4%. If we look at the growth in earnings, 3%, the total return should be 7%. The total return was actually double at 13% for the S&P 500. So 2 plus 2 can be 2 for a decade, or 2 plus 2 can be even 6 for a decade, and then crash back to 2. That is the stock market. Small mistakes in engineering have big consequences. Fortunately, big mistakes in investing have big consequences, and small mistakes you can often get away with it because long-term investing is a positive-sum game. So you have to make decisions with significant unknowns. The first unknown is I don't know what the stock price will look like tomorrow because it is in the future. And me and any engineer that I have spoken with, we cannot yet predict the future. But then again, we have the intrinsic value calculation template that can help us discuss a little bit, let's say, the scenarios when it comes to investing. And that is why when you come to my intrinsic value calculation, here it shows one number. But if you check how it is calculated, you get to 3 scenarios. So my intrinsic value calculation for Berkshire is from 287 billion up to 770 billion. That's a huge variance, and that is something you have to expect as an investor. If you want to be a value investor, then you do it simply engineerically. Only when the margin of safety price is reached, does the stock crashes 70% from the current level, you check it and perhaps act on it. Everything else is a lot of gambling that I'm not even trying to explain, because I have no idea where will the stock go based on exuberance plans. So if you're an engineer, or if you're thinking of applying a mathematical perspective on your investments, be sure that the market can change, the fundamentals can change, the perception, the prices especially can change. So when it comes to this, simply as we did with Berkshire, become more, not vague, but adjust more those fluctuations. As Buffett says, it's better to be vaguely right than precisely wrong. And that is the first step when it comes to mathematically analyzing investing. What does it mean to vaguely right? If a stock price is 50 and the market hates uncertainty, and let's say in the next 2 years it can be 50, it can be 100. So you are not losing money, which is a positive, and then to 100, maybe it will go, maybe it will not go. On average, then you imply statistics, on average some will go higher, some will go lower. But it's not necessary that a stock with a P ratio of 10 might not be at a P ratio of 5 in a few years. A stock at a P ratio of 30 might be at a P ratio of 60 in 6 months. That's how the market goes. So the main message here is be much more flexible and try to go for those few certainties, which is a margin of safety. Whatever happens, I am okay, and then leave the upside to calculations and always focus on the business. Do not connect it with the stock price, expecting that the stock price should do this or should do that. That's usually how analytical minds get tricked when it comes to investing.